Mechanical click of an automatic transaction confirmation on your smartphone screen at dawn carries an underlying truth that modern financial media spends billions attempting to obscure. That quiet notification confirms an automated deposit of 140-hour traffic, endure a performance appraisal, or bill 50 billable hours to secure that liquid capital. You did not sacrifice your finite physical energy to balance an operational budget or manage an aggressive client dispute. You simply held verifiable legal. Most modern professionals spend 40 years operating within the fragile, exhausting confines of linear labor arithmetic. That arithmetic dictates that one single hour of your physical or cognitive output yields exactly one discrete unit of gross compensation. The fundamental vulnerability of linear labor is that the moment you pause your personal effort due to illness, restructuring, family obligation, or sheer exhaustion, the revenue pipeline drops to absolute zero. Data published by the Federal Reserve indicates that nearly half of adult wage earners would exhaust their liquid safety buffers within 90 days if their primary labor income were interrupted. When your ongoing lifestyle, housing security, and baseline dignity depend entirely on the active sale of your next 8 hours, personal autonomy remains an illusion tethered to the goodwill of an employer. Dividend investing dismantles this structural trap by transitioning your role from a vulnerable vendor of labor into an owner of productive economic infrastructure. When you purchase a dividend-sustaining financial fortress that produces reliable cash independent of your labor, you must stop treating equities like casino chips and begin managing your portfolio like a private holding company. The structural foundation of dividend investing is supported by extensive historical data that speculative retail market participants routinely ignore. Long 9% of the total cumulative return of the S&P 500. When you isolate specific multi-5% of total investor returns, during extended decades when equity market price indices move horizontally and generate zero capital gains, the physical cash distributions paid into your account continue to accumulate, providing positive total return while active traders suffer capital attrition. If your entire investment methodology relies exclusively on capital appreciation without underlying cash flow, your solvency depends entirely on the willingness of a future buyer to pay more for your asset than you did. That speculative reliance forces you to become a hostage to market sentiment, macroeconomic liquidity shifts, and collective behavioral psychology rather than corporate cash profitability. A seminal historical study by Ned Davis. Research categorized S&P 500 companies across a 50 paying companies consistently outperform broader benchmarks over long horizons because the mandatory commitment to distribute cash forces corporate leadership teams to exercise capital discipline. When an executive team knows it must distribute hundreds of millions of dollars in real liquidity to shareholders every quarter, management cannot easily squander capital on overvalued corporate acquisitions or vanity projects. The recurring dividend obligation serves as an unyielding operational governor that systematically prevents executive overreach and forces capital allocators to fund only their most profitable enterprise initiatives. Furthermore, a recurring cash distribution serves as unequivocal proof of authentic economic earnings that cannot be manufactured through aggressive accounting tactics or non-negotiable capital allocation rules. The first rule is the rigorous prioritization of dividend sustainability over headline dividend yield. Novice market participants frequently commit the catastrophic error of filtering stocks by the highest visible percentage payout, unknowingly allocating capital into decaying businesses experiencing terminal decline. A dividend yield of 9 or 10% on a legacy enterprise with falling operational revenue, contracting margins, and an unsustainable payout ratio is an indicator of an imminent dividend reduction rather than a reliable income source. You must look past nominal yield and evaluate the free cash flow payout ratio, ensuring that the enterprise utilizes no more than 50 to 60% of its normalized operational cash flow to fund its distribution. This conservative margin of safety ensures that even during severe macroeconomic recessions, the underlying business can service its debt, reinvest in core operations, and sustain its payout without borrowing capital. The second operational rule is establishing a systematic dividend reinvestment plan, commonly known as a DRIP, to automate exponential compounding. When your holding company, by automating the immediate purchase of additional fractional shares through dividend reinvestment, you trigger an accelerating mathematical feedback loop. In the initial quarters, your existing shares generate enough cash to acquire only a small fraction of a new share. Over a 10-sector diversification, by allocating capital across established enterprises operating in healthcare, consumer essentials, industrial machinery, if an investor commits to systematically investing $1,000 per month into a diversified basket of dividend growth equities, yielding an initial 3.5%, with an annualized dividend growth rate of 7%, the trajectory of their wealth shifts profoundly. In year one, the portfolio produces a modest annual cash flow of roughly $420, a sum that barely covers a monthly utility bill. In year 10, the combination of consistent capital contributions, organic corporate dividend increases, and automated dividend reinvestment expands that annual cash flow to over $9,500. By year, $24,000 per year, completely detached from the investor's daily labor or active physical presence. At that threshold, your living expenses are permanently underwritten by global economic commerce, leaving your primary human capital free to pursue high-generating assets at attractive structural discounts. True financial sovereignty is not measured by the volatility of your net worth ticker on a speculative trading application. It is measured by the predictability of the cash flows that sustain your life when you choose not to work.